Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to go over the Consumer Price Index report for March 2022. The index was released this morning at 8:30, and the results were pretty eye-popping. The overall year-over-year inflation rate has shot up to a seasonally adjusted 8.6% inflation, which is equivalent to a 1.2% monthly increase, and this is the highest inflation rate that we have seen since late 1981. So we have to go back to the depths of the great inflation cycle that hit the U.S. economy from the 1970s, late 1970s to the early 1980s. And now we are seeing this sky-high inflation rate that has been driving up consumer prices to the highest levels that we've seen since then. Overall, when we take a look at the breakdown of it, the big jumps have been obviously food and energy. Energy increased by a whopping 11%. A lot of this had to do with the impacts of the geopolitical situation developing between Russia and Ukraine. As the Russian invasion of Ukraine has hit full swing, the sanctions that were placed on Russia, cutting off that oil supply from coming direct to market, has caused energy prices to jump. And this is really being seen right now in this CPI index that we're going on. Food prices were also hit in part because with Ukraine being nearly obliterated by Russia, a lot of the production of certain agricultural products also hit the market, cutting off that supply, making these prices jump higher than what they otherwise would have been. Now, the reaction to this news was a little bit mixed. The Dow Jones started off higher this morning when the inflation report first came out, because when we take a look at the core inflation rate, that is the CPI subtracting out food and energy, it only increased by 0.3%. We'll come back to that in just a minute. So investors were initially bullish. They're like, well, the energy and the food prices are high, but those are volatile components. Core inflation was lower than what we expected, so maybe this is a sign that inflation has peaked. And so some of that narrative has come out into more of the hopeful, optimistic side of the markets, as this wistful idea that maybe inflation has peaked and will calm down in the latter half of 2022 is true, because we got 1 month of a 0.3% core inflation increase. But as the market dragged on today, it went into the negative. The Dow Jones has dropped for the day, and overall for the past 6 months, it's been largely flat, as high inflation, which would normally push up asset prices, has been weighed down by higher interest rates, especially with the onset of Fed quantitative tightening. When we take a look at the small cap stocks, such as measured in the Russell 2000 index, we really see the brunt of stocks getting hit, as this index has dropped 11% in the past 6 months. Bitcoin, which represents a more sensitive speculative market, has dropped 29% in the last 6 months, so nearly 30%. And in the meantime, silver and gold are on the upswing. Silver is up by some 15%, gold is up by some 10% just in the last 6 months, and that's pretty much falling within the realm of my expectations. Now, last month, I had predicted a monthly change of 0.8%. I know that this table on this Excel chart, and I'm going to magnify it here so you can see it, which says 0.9, but I'll go into that in just a second. My original forecast was for a 0.8% increase, and the high side would come out to 1.3. I did say that in the last report forecast that this measure only takes into account economic data. It does not take into account the impacts of the geopolitical situation, which would likely push this inflation rate higher. Now, since then, I have modified this CPI projection table out, and I've now been able to get it to 95% accuracy within a 0.5% plus or minus range. So it's still a high range on capturing the CPI data, but more or less I've gotten and been able to fine tune it out to be more accurate. And so now the revised CPI projection was forecasting a 0.9% increase this month. And I think we probably would have gotten that or something similar to it had we not had the war break out in Ukraine and Russia. That kind of pushed inflation rates over the edge, increased it up by 0.3% or so. So instead of this 8.2% year over year, we got the 8.6%. Now let's go back to that core price inflation. We see here that it's at 0.3%, right? So ultimately that might give us some ideas and say, well, wait a second here. Core inflation last month was 0.5%. The month before that was 0.6, and so on and so forth. So maybe what we're seeing is a calming down in this core inflation, which will feed over into the more volatile components. However, looking deeper into this, what we see is that the inflation rate jumped on just about everything in every other category, save for two areas. One was in motor vehicle maintenance and repair, a subset of transportation services, which still jumped by 2%. I'll go over that in just a second. But the big one that dragged down this inflation rate was the drop in used car prices. So used car prices year over year is at a whopping 35%. These car prices were spiking very high due to supply shortages and chip shortages. Well, because that particular component of the index dropped by nearly 4% in a month, that depressed this food and energy striking out core inflation cycle, okay? So if we were to take out and strip out this negative component to this inflation rate, what would it have created for this inflation rate? Well, it would have meant that the core inflation would have been at about 0.5% instead of this 0.3, okay? So that's really what depressed that. And so one little area compared to the rest does not mean that we're finally seeing the peaking of inflation. It's just due to the fact that used cars and trucks spiked so high earlier in the year over year. And so now we're finally seeing a relative drop month over month in that inflation rate. So looking at the monthly changes, we see a lot of the driving up in prices is going into the COVID sensitive areas. For one thing is that we see that shelter component increased it by 0.5%, but rent and owner's equivalent rent only increased by 0.4%. Well, there's another component that factors into the shelter component, and that's the rent. That is the price of hotels and things. Those got really hit during the breadth of the pandemic as people and consumers, afraid of contracting COVID, would not go on vacation and rent out and use those hotel services. So the hotel prices stayed relatively depressed. Well, now we're seeing them spike, and that's been pushing up the shelter component. Another thing that has jumped up monthly has been airline fares. So airline fares have increased by a whopping 11%. They're up by 24% year over year. That's also factoring into this inflation. So now that we're seeing the U.S. economy come out of the COVID pandemic shutdown cycle, we're now seeing inflation hit a more breadth of the CPI, and because of that, over time, it's going to push this CPI up. Now, one of the things that I find striking here is that the shelter component is still not where I think it should be. Even though it increased by 0.5% this month and year over year is at 5%, we've been seeing housing prices skyrocket by 20%. Rents have been increasing by 10% according to certain private statistical measurements. And yet what we're seeing in the rent prices is only 4.5% increase. And the same is true with owner's equivalent rent. So I don't believe that the complete housing component and the increase that we've been seeing in houses and the demand for homes has really been ingrained inside of the CPI. If we used the pre-1983 standard of the CPI, we would be more than likely seeing more of that component being edged in, which would be pushing up these year-over-year inflation rates to, say, over 9 to 10%. And something that kind of justifies this is an alternative metric that I have created that approximates the CPI, and I call it the Business Expense Index. This Business Expense Index is merely an average of the median wage and the Producer Price Index. When you index the two together and take the average, you get pretty much the CPI. The two indices tend to run together, my Business Expense Index in orange, the Consumer Price Index in blue, and notice how they tend to run in line with one another. Well, if we take the year-over-year change in my Business Expense Index, for quarter four, the year-over-year change is 10%. But yet in the CPI for quarter four, for the entire quarter averaged out, the CPI increase was only at nearly 8%. So we will more than likely see this jump happen inside of the CPI. And when it does, there'll be some catch-up that it plays to this Business Expense Index. So If you notice here, when you take a look at the graphical chart going all the way back to 1979, it's very rare when the business expense index runs ahead of the CPI. And when it does, the CPI usually catches up within the space of a year or two. So as the year plays out, if this business expense index stays higher than the CPI and the two continue to push up together, we might see the CPI catch up to it, which means that later on in the year, we could be looking for the CPI to actually hit around 10%. So I've got it right now in my chart that I've got it in my projection for the rest of this year, the CPI to slowly build year over year and probably hit closer to this 10%, if not hit 10% or higher by the end of this year. And that's going to be very drastic. So silver and gold has been occurring and been rising as I've predicted. I think that psychologically, when we hit over this 9% and 10%, this is going to really cause a bullish sentiment into silver and gold as we start seeing things play out much like they did during the 1970s. So we saw this run up in gold and we saw this run up in silver, especially as inflation hit over 10%. Followed by rising interest rates, which will depress the stock market down as well on the small caps and the large caps, as well as Bitcoin. That money's got to go somewhere. It's not going to go into bonds. It's not going to go into stocks. It's not going to go into Bitcoin. The likely culprit is going to be precious metals, and we may see a late-term surge in that as early as this year. I'm not going to go out and say that we will and say that we're going to have this run up in gold and silver, but I do think that if we start seeing the inflation rate continue to push up, as I've been looking at other metrics and they seem to be indicating that we will, then more than likely we are going to, the conditions are there where we could have a really strong bull market in gold and silver. We could see gold push well north of $2,000 an ounce, probably north of even $2,200 an ounce, and silver pushing north of $30 an ounce by the end of this year. Could be even higher than that, though I would need to go and put pen to paper and do the math on that. And guys, that's all that I have for this video. I want to thank you for watching this. Make sure you just like, share, subscribe. Like this channel, like my video, show me some support, share my content. If you find other people or groups that you have on social media, you're more than welcome to share my content. Subscribe to my channel if you haven't already. That way you are privy to be notified as soon as I do upload a video. And as always, you can click that notification bell. Clicking that notification bell will make sure that as soon as I upload a new video, you will be notified, and then you can view the content for your own enjoyment or to your own displeasure, as most of the data that I provide you has been quite dismal. Once again, guys, I thank you for watching this video. Stay tuned for my next video. Next video is going to be on the Producer Price Index. That should be coming out, I believe, this Thursday, so in 2 days, and I will give you an update on that and then update my projections for the CPI for April. So watch out for that, and I'll talk to you next time.